themselves a question, right? It's, gosh, I keep watching the stock market go up. Should I just keep getting more long because this is going to last for a while? How do you answer that?
Well, we really tend to see historically that actually strength begets more strength, right? You tend to have more all-time highs following all-time highs, especially once you've had a bear market, of course, related to the pandemic and rates there briefly. And now we're at the start of a new bull market. And for next year, we still expect a pretty decent, pretty normal economy with a recovery in earnings across various sectors that had a bit of a tough go there the last 2 years. So that's still an environment that's supportive of equities. But if you think about should you be adding, I think you really should ask add what exactly. And the odds are that there's probably a heavy amount of exposure to a handful of stocks. We all know and love them within the growth style, within the AI tech theme. And really what we've been seeing since July is much more opportunity in other sectors and in market cap, like mid caps. So
you have even more conviction today in the broadening story than you did prior to the election. Is that fair to say?
That is fair to say. And I think one reason is just the earnings delivery that we've had from other sectors. We're now seeing 3 quarters where we've had alternating between 8 or 9 sectors seeing positive earnings growth after an earnings recession last year. You are seeing signs that margins do seem to be stabilizing for sectors outside the Mag 7. So more conviction in that earnings delivery continuing next year. But then post-election, I think a lot of the expected impact in terms of a slight boost to nominal growth or deregulation, those tend to be much more beneficial to your value sectors and to a lower cap, and a good sweet spot for us is the mid cap sector.
One of the points you make is that, you know, and it is directly related, I think, to the election, is it's a fiscal policy story now more so than a monetary policy one, right? We've adjusted our expectations on what the Fed is going to do and when it's going to do it. And now we think, because of the result of the election, that you're going to get more fiscal policy, which is going to be towards that growth story.
And I think that's exactly right. I think for now, this month, next month, we're still, going to continue playing the Fed parlor game. Exactly how many cuts do we have left? But they're telling us pretty openly that they're closer to the end of the rate cutting cycle, which is fine. It's
closer to the end of the rate? I mean, even if they pause, I don't know that they're necessarily close to the end. They just started.
But I think that there's a broad understanding within the Fed and in the market that the neutral rate is substantially higher than it was. If you look at the range in the dots, which we'll get new ones in mid-December, it ranges between a 2.5 and a 3.8% neutral rate. And that's because of the resilience of the economy, the improvement in productivity. So we might be getting close to that plausible estimate of neutral 3 rate cuts from now. And then maybe it's a pause, maybe it's just the end. But as long as it's because it's resilient, that's fine. Where I think we'll get a lot more volatility in action is related to the tax bill next year. How much, in addition to the expected $4 trillion in extended tax cuts, do we get? And that's something that could keep the 10-year between a 4 or 5% range.